Hello, and welcome to the Horizon Investments Quarterly Review and Market Outlook. My name is Austin Fitch, and I'm here with our CIO, Scott Ladner, and we're excited to get into a conversation today about markets as we wrap up 2023 and really jump into 2024. Welcome to everybody that's with us today. We're excited to have you. Names on the list of folks here, and really excited for that as we get into the new year. I will say we have been asked to share that a recording of this webinar will be made available hopefully within the next couple days. So if you're on the invite list, you will be getting that recording. Do not worry about that. That'll be coming out as soon as our friends from compliance get done with any edits or their review. That being said, though, we're going to jump right into the conversation today. And you can see here on the screen kind of the topics that we're going to cover. Really, it's probably a lot of things that you're getting questions about. Right, we've got a lot of folks asking about the business cycle and what that means from a recessionary standpoint. Obviously, we're going to talk about inflation and the Fed's response over the last couple of years and what that means as we get into 2024. We've talked for a couple quarters now about the consumer and what that means from a recovery standpoint and the recession piece of the equation. The productivity piece we actually touched on really for the first time as we got into the summer months of 2023. But we're going to continue that conversation because the AI conversation that we're having from just a broader economy standpoint is not going away. So we want to make sure that we touch on that. And then finally, we're going to get into kind of what the fundamentals tell us. What does that mean from an investor positioning standpoint? What does that mean as we look out into 2024 for balance sheets, income statements, those types of things? So those are kind of the agenda topics for today. But like I said, we're really going to start with this idea of a business cycle. And we wanted to share this first chart here as really just a reset for everybody that's familiar with the business cycle. As you've probably learned at some point in an Econ 101 class or business school at some point. Scott, maybe I'll bring you in here. This is a chart literally that we brought out of Encyclopedia Britannica that gives us an overview of an economic cycle. Let's share with folks, like, why are we even talking about an economic cycle? And then how does that factor into the fact that maybe we didn't get a recession in 2023?
Yeah. Hey, look, thanks, Austin. And any chance we have to bring in Encyclopedia Britannica, I will. And so you're all welcome for a trip down memory lane real quick. But the important part of this chart isn't the fact that it came from something like Encyclopedia Britannica, but it is the fact that I think this is causing a lot of confusion. So I think the reason why a lot of folks kind of have gotten this wrong over the last year is because they're approaching economic analysis, they're approaching the economy, they're approaching markets with this basic framework in mind. Like this is the mental map that they're using to understand what's going on in the world, and that has generally been a pretty good mental map to use. I mean, if this business cycle thing exists, like everybody knows because it exists and because it generally works pretty well. That's the reason why leading economic indicators tend to work pretty well because they lead on a cycle like this. The problem is really come up though in the fact that I don't think what you can describe as the COVID period, broadly speaking, like the entry into COVID, all the things that the government consumers did through COVID, and then our subsequent exit out of it over the last year and a half, can be described anything like that looks anything like this, frankly. And so if this is it, so what do I want to do? What do we want to do with this? With these first couple slides is just try to reset your mental map. Reset your framework about how you're thinking about the economy, how you're thinking about markets. And I think if we can change our map from a cycle kind of sine wave looking thing to something a little bit different and hopefully a little bit more appropriate, we'll come away with a better understanding for what's been driving 2023, what did drive 2023, and more importantly, what we think is going to be driving 2024.
And Scott, you touched on the fact that that business cycle, that economic cycle, really sets the stage for leading economic indicators, lagging economic indicators. I think we've all seen some version of one, if not both of these charts over the last year. That we just literally grabbed a couple screenshots from I guess what used to be Twitter, now is X, in regards to folks predicting a recession because of economic indicators that suggested that we were headed into a recession. As Scott, though, you talked about, it's really hard to predict a recession if you're not in that normal business cycle, which I think then kind of brings us to this next slide is, okay, so if we're not in a traditional business cycle, like what should we be using as a mental map to be able to set that framework.
Yeah, and also I think, and this is I think probably the most important point. I think that the framework that we can use to better understand what's been going on in the last few years is more of a war and war recovery type of framework. And so, if you look, just pulling some data out of World War II, which is the last time this was really applicable. And by the way, part of the reason why everybody's gotten this wrong is because nobody actually was managing money. Nobody is managing money today. It was actually managing money, 70 years ago, 80 years ago, whatever it is. And so, it's sort of it's understandable, maybe not excusable, but it's understandable why so many people got this wrong over the last year because they don't have experience with it. But if you think about the dynamics that govern sort of a war and a war recovery type of economy, it's a massive amount of fiscal spending. Okay, check. It is labor shortages. Well, people are guys are fighting wars or people are sick and not able to work, so check. And it's supply chain disruptions, either because of the global world war or because of a global pandemic like we just went through. And the sum of all those things is excess demand and a restriction of supply. And so you get this inflation bump that ends up being transitory. So transitory, we just had transitory inflation. By the way, we're back down to inflation targets. So inflation was in fact transitory, like that dirty little T word that Powell mentioned a few years ago, and he got chastised for a while. It was right. It was transitory. It's done. It's over. And it to be just like it was in through World War II when that came off. And so that combination of massive fiscal spending and supply disruptions, whether both in the labor market and the goods market, leads to these types of weird economic outcomes. And so I think while it's not perfect, like none of these things are perfect, but I think that in terms of framework, we're thinking about frameworks and mental maps about stuff. I think the wartime setting, the war recovery setting is a far better framework to use when we're thinking about these things than a traditional sine wave looking business cycle.
Scott, we're less than 10 minutes in and you've already said transitory. So I feel like we got to dive in a little bit more as we talk about this transitory kind of phrase. Is it fair to say, though, that maybe when it was initially talked about, when Powell started using that phrase, folks thought that transitory meant 3, 6, maybe 9 months, when in reality it was 2, 3 years?
Yeah, and look, which again is understandable. We have kind of an instant gratification type of system now, and so when we think about transitory, we measure things in minutes, not in quarters and months and years, and so by that definition, yeah, it wasn't transitory, it was persistent. But in any sort of like global macro type of framework, we're thinking about things over longer time frames than minutes. I think that when we look back on this period in 5, 6, 10 years, it will be incredibly obvious that this wasn't a transitory inflationary period driven by some of the disruptions that we just talked about.
So Scott, we've started kind of the conversation around inflation. I think you mentioned it, the fact that inflation is really back down to kind of that target range the Fed's shooting for. Maybe it's not there from a headline perspective. And I think that's what we want to unpack on this slide is, okay, so let's look at inflation using more real-time data. So we've got a couple different kind of measures that we're looking at. One is taking out kind of the shelter component of CPI and replacing it with more real-time data. That's the chart on the left. The right looks at that true-flation measure of inflation, which we've used in the past. It's more of a real-time measure. I think, Scott, both tell us that, like you said, we're back down in that 2% range. I think what's also interesting is that if you look 2, 3 years ago at this point, you're also seeing that inflation may have actually been higher than headline numbers suggested at that point too, right?
Yeah, absolutely. Look, I mean, when we're measuring something as tricky as really, really volatile inflation, or like really, really volatile anything, you want to get as high frequency data as you can to estimate these things. And so, the chart on the right, the true inflation data, it just takes a lot of real time types of data. And the chart on the left, like you said, Austin, is just using more real time shelter data. And the shelter is probably the most problematic part of the CPI or PCE calculation right now. The government puts out, it's just really laggy, really slow. Like we all know what's going to happen over the next 6 months, but it takes a while to get in the numbers. So, if we can take those kind of problematic parts of the inflation calculation and replace them with more, faster moving, more real time types of numbers, we get a picture about like what inflation is likely to look like when the official government statistics come out in the next 3 to 6 months. And this is what they're going to say, like barring something else happening, barring the disinflation that is in the pipeline right now. Is likely to be realized, and that means that we're basically back down to the Fed's 2% target.
So Scott, you talk about kind of being at that 2% target point. I think one thing that we've talked about internally, I know we've gotten a lot of questions about is, okay, so what does that mean from a labor market standpoint? It seems like the labor market is softening. Is it softening too much? Or, have we gotten to a point maybe where it's starting to really kind of tighten up? This slide starts to unpack that. And I think we make the point that there had to be a softening for the Fed to pivot. But now I think the question is, where are we from a labor market perspective?
Yeah, look, the labor market was probably the scariest part of this inflation call that we've had for the last 6-9 months, because the Fed cares so deeply about it, and because and the reason why they care deeply about it is because the wage price spiral from the 70s is like just hewn in their heads. So I mean, they were very, very worried about that type of dynamic happening again, and so that is they were going to fight like crazy to prevent that from happening, or from having a chance to get off the ground. And so, for the Fed to be able to pivot, the labor market had to start to soften. It had to kind of start to normalize. And what we're going to show, in this chart and maybe another chart or two, is that's happened, right? So, this is coming from the JOLTS numbers, but we're going to show you 30 different charts that's telling the same thing. We had too many openings, too many job openings, like too much demand for labor, not enough supply of labor. Therefore, the most part of 2021, a lot of 2022, it has started to normalize, during 2022, and now we're basically back on trend. So, what I want to be careful about is we don't look at the pre-COVID number. Like the pre-COVID number, it was just a point in time. These things have trends to them because the economy has trends to them, and so we have to take account of where absent COVID, if COVID never existed, where would this number have been? And this kind of job openings number is basically back to where it would have been if COVID had never happened. And so that is a normalization of the labor market. Not too hot, not too cold, but in a place now where it's at least possible for the Fed to be able to pivot.
Well, and Scott, I mean, we've used the term softening a number of times now. I think it's important to make the distinction that we're not saying that the labor market is soft, right? If you look at the previous slide, yes, we're below that trend line that you just talked about, but we're not yet anywhere near kind of that soft scenario. And maybe let's unpack this chart right here, because I think what it shows is, again, yes, things are softening, but we're by no means at a point where we're concerned about the labor market.
Yeah, and this is an important point to get right, because if the labor market doesn't soften, I mean, if the labor market gets too soft or it goes into contraction, then we're probably talking about recession. We're talking about a different type of scenario, a different type of Fed reaction, different type of everything. But if we can get the job market normalizing because people just slow down on hiring, but they don't fire a lot of people, which is what has happened over the last 6 to 9 months. Then you get a picture that looks like this. So what we're looking at here, again, under the rubric that we need to use as much real-time, fast-moving data as we can to analyze fast-moving dynamics and phenomena in the economy, especially in a time when things are very, very volatile. This is trying to make a relationship between the weekly number that we get in terms of initial jobless claims and the more slow-moving kind of monthly, probably frankly more important number that the government and the Fed looks at in terms of the employment, the unemployment rate, non-farm payrolls, those types of things. And so what we can see here is with the weekly claims numbers that we get every single Thursday, we're in a pretty solid spot. We're in a place right now where it's still predicted that we're getting employment gains. The employment market is healthy. It's not super hot where people are having to pay up like crazy and we're getting wage price spiral stuff. But it is not anywhere near the place where you start to get actual labor declines, like job market declines. People are actively firing folks to try to cut costs and whatnot. And you don't get there until you get weekly claims at around the 400,000 per week number. We're sitting right now with a 200,000-ish per week number. So we're a long way away from the labor market being in place where it'd be a problem from an economy standpoint. But it is in a place right now overall, the labor market is, where the Fed actually has the ability to pivot if they think they need to.
So that maybe, Scott, brings us to kind of the point that maybe a lot of people are asking about at this point is you talk about the Fed pivot. Expectations around what that means have changed pretty dramatically over the last year, right? It went from they were gonna start cutting rates as early as 2023 to all of a sudden, they weren't going to cut it all in 23. Maybe they weren't going to cut until the end of 24. That's shifted again. Maybe let's kind of unpack this chart because I think it paints a picture of what rate cuts maybe start to look like as we get into 2024.
Yeah. So what we're trying to do here is just show how many times the Fed predicted to cut by the market over the next 2 years. The light shaded area on the top is how many cuts are priced for 2024, and the one and part of the bottom is how many priced for 2025. And so in total we're talking about 9 cuts ish. So talk 2 to 2.5% lower Fed funds rates from here is what the market is pricing over the next couple of years. But as we can see from this chart, it's massively front loaded. And by front loaded, I mean most of the cuts are being priced to happen this year in 2024, which we think is actually very appropriate. Because if you think, the Fed by its own admission, by its own calculations, by their own models, the Fed believes that they are very restrictive right now. So they think that their level of interest rates is doing active harm to the economy. They're intentionally trying to do active harm to the economy because they had an inflation problem for a while. But they have that level of rate set right now that they think is appropriate if they have an inflation problem. What if you don't have an inflation problem? But then all of a sudden, their rates are way too high if they don't have an inflation problem anymore. And so what they're coming to the realization of, and what we've heard in the speeches, especially Powell's over the last month or so, is this idea that we think that inflation may not be as big of a problem, and now we're a little bit more worried about growth. We're a little bit more worried about tipping the economy into a completely unnecessary recession. And so we need to get rates back down to a place where we think they're normal. And normal to the Fed is this idea of R star or the neutral rate, or however you want to call it. But basically, Fed funds back in the 2.5 to 3% range. And so if you get from 5 or 5.25 down to 2.5 to 3%, you're talking 8, 9, 10 cuts, depending on kind of how you want to cut that up. And so that's basically that's what the market is predicting. The market is predicting the Fed not to have to cut way down to be accommodated because they're not pricing recession, but just to get rates back down reasonably quickly, because they got rates up reasonably quickly, and that reasonably quickly over the next year and a half to what the Fed considers to be normal, because we don't have an inflation problem anymore.
Yeah, and Scott, just to clarify a couple of things, when you're talking about 8 to 9 rate cuts, we're talking about 25 basis point rate cuts in this scenario, right?
Yeah, sorry.
And then the other piece here, and we've heard this conversation, is basically what the Fed is telling us is if they're not cutting rates, they're implicitly hiking rates, given the fact that inflation has now come down. Is that kind of how we should think about it?
Yeah, that's a really good point, Austin. I'm glad you brought that up. One way to think about the idea that they need to cut in order to because they don't have an inflation problem anymore is if they do nothing. If they maintain rates where they are right now and inflation is coming down quickly as it is, they're actually tightening. They're making things worse. They're making things more restrictive by their own models, and that's something that they don't not only do they not want to do, they don't need to do it. And so they're trying to land this plane, and so far they've done a reasonably good job.
So Scott, the other thing that we'll touch on from a rate perspective, which I think is super interesting, is if you actually look at global central banks, which I think it's fair to say, obviously the Fed is probably the most important. There are a couple others, right, that are kind of up there at the top of the list. But if you actually look at global central banks, the number of central banks that are now cutting rates as opposed to central banks that are hiking rates has actually crossed back over kind of that zero line, and we're back into kind of period where more folks are now cutting rates, kind of net policy, if you want to think of it that way, as opposed to hiking rates. And that's the first time, Scott, we've really seen that since basically, COVID. So the last, 3.5 years at this point. I think that's something that we definitely have to mention just from a global perspective. It's not just the U.S. It's a number of other central banks kind of making those policy moves that are important. Shifting gears maybe a little bit as we talk about the consumer, and we talked about the consumer quite a bit really over the last year. I think the consumer being key is something that we just want to continue to reiterate because what we talked about is kind of that economic strength component, especially within the U.S., but also globally, is going to continue to be driven by kind of the economic health of the consumer. So Scott, maybe let's give them a sense of what we're seeing from a data standpoint, and then why maybe we're as maybe optimistic or positive when we think about the consumer, as opposed to other folks out there that are, suggesting that we should be concerned.
Yeah, I mean, so the starting place for if we're talking about the consumer is, how are they economically, health-wise, how are they? And that starts frankly with labor income. That starts with how much money are they making. And so this chart on the left is something that we call total payrolls. And so that is just how many people are working in the country times how many hours are they working times how much are they getting paid per hour. broadly speaking. And so that's what this number is seeking to capture, is like how much total labor income is coming into the consumer in this country. And so what we can see out of this is for a while, like when we had that big inflationary problem and wages were going up really crazy and employers were really fighting for workers, people were making too much money. Like they were just making a lot of money, and that was helping feed on some of the inflationary problems. But the dark dotted line there is the average of the kind of the pre-COVID period, 2016 and 2019. That was sort of the total labor income that the economy was generating before COVID was a thing. And what we can see is like the last 6-9 months, we're kind of back to that. And so again, this is just like one more picture as to like why is the Fed able to pivot right now? Why have they started changing the rhetoric? Why are they going to start cutting rates here in the next couple of months? It's because this labor income story, this wage price spiral initiator, like that, that match is wet. Like it's not, that's not a problem right now. And obviously the reason why this matters to the economy is the right side of the screen. The right side of the screen is, one of those lines is this total labor income. The other one is how much money are people spending for consumption, personal consumption. So if 70% of the economy is consumer consumption, which it is, then understanding the sources of that, and it should be coming from labor income, and it is. And so understanding the labor income, like, and how it relates to consumer behavior and consumer spending, what really drives the economy, and the economy drives corporate profits. And at the end of the day, like that is the thing that we're really going to end up talking about at the end of this presentation. But it's just looking at this labor picture, look at this labor income picture, and relating it to total consumer spending draws a pretty nice picture in terms of this has been a transitory shock that we are now in the process of normalizing, if it is not already normalized.
And Scott, as we talk about the consumer, I think it's really important to some extent kind of debunk some of the data that's been put out there. Is if you start to look at some of these data points, I think what we've seen is a lot of, maybe call it media outlets, a lot of your websites, even the CNBCs of the world have basically taken headline numbers that can be kind of I guess eye-popping, if you will, and maybe attention-seeking, and really unpack those. And I think what we found is you always have to make sure that you're looking at the data through the appropriate lens, right? We talked about perspective last quarter, and for the next, I guess, 2 slides, we're looking at the U.S. consumer through a kind of relative lens, right? And we've heard a lot of conversation about liabilities, right? There's been this uptick in liabilities at the consumer level. However, if you normalize that for their net worth, which we talked about a little bit earlier, we've got a slide here in a few minutes that we're going to talk about it some more. If you actually normalize that for net worth, yes, there's been an uptick. Is it concerning in the grand scheme of things? No, it's barely a blip on the radar, right? You can see that within this chart. So again, we jokingly say scam alert, but more it's this idea that yes, the underlying data, if you just look at liabilities and kind of that aggregate number, it can look concerning. But if you normalize it for the changes that you've seen in some of the net worth statistics, right, it's maybe not as concerning. Same thing on the asset side of things, right? If you look at deposits and what's in checking accounts, for example, right? Have they come down? Yes. Over the last 6, 9, 12 months, you've seen kind of some of that money kind of come out of those checking accounts. Maybe they've gone back into paying for bills or those types of things. However, put it into context relative to net worth. How much money does the end consumer have in their checking account relative to that net worth? We're still as healthy as we've been in 40 years. So those are the types of things that, again, as we talk about putting it in perspective, it's really important to understand kind of this idea of the consumer and the health of the consumer. That's not to say that everything's, rainbows and butterflies. We're sitting here telling you that things maybe just aren't as bad as some of those headlines would suggest. The fact is maybe the consumer's not bloated, not levered, not overstretched like we kind of highlight here. The consumer is actually in a decent spot. Again, we're not going to tell you that everything's perfect, but we are going to tell you maybe it's not as bad. Scott, is there anything that you would add to either of these past 2 charts that would say, hey, the consumer is in a good spot, bad spot? Any thoughts there?
I would just say, again, if we're going to pull back and look at a little bit bigger picture, just the understanding that what we went through, and you don't see it in this chart as much as you did in the last chart, but there's a zillion of these things we could look at. What we went through from the great financial crisis until COVID hit was just a massive amount of deleveraging. So that the consumer took a lot of debt off their balance sheets. They paid down a lot of things, and they weren't taking loans. They were being very, very cautious, paying down stuff. But with that's a long, painful process. It took over a decade to accomplish, but it got us in a pretty good financial spot from a household standpoint. I don't like if we forget that, you forget that at your own peril, because the starting place in this stuff is matters. You've heard me say that a bunch of times. But the starting place in this stuff really matters a lot. And the fact that we went through that deleveraging period from 2008 until COVID hit is a really important piece of information that you just need to keep in the back of your head when you're hearing tales of like over-levered consumers.
So Scott, as we talk about kind of that, that relative comparison, why it's important, and maybe why it doesn't look anywhere near as bad as some places are suggesting, has more to do with what we've seen from a net worth increase over the last 3 or 4 years at this point, which is really interesting, regardless of what income quartile, quintile, segmentation that you're looking at. So Scott, maybe show us what we're looking at here, and then let's unpack that a little bit.
I'll tell you what we're looking at. We're looking at rainbows and butterflies right here. You want to see rainbows and butterflies like that? Like here's a rainbows and butterflies chart. Again, one of the objections that I hear when I say all these positive and sort of optimistic things is like people are getting crushed by inflation, and poor people are getting crushed by inflation. There's a lot of rich people that got made out through COVID and so on and so forth. It's like maybe in pockets, but it's not coming through the data. So we can look at different, like you also said, different income quintiles here, from the very well off to the not as well off. The not as well off are on the left hand side, the very well off are on the right hand side, and inflation is the box. So net worth wise, everything has come through. Everybody's come through this period better off even on an inflation adjusted basis. And so that is, if you kind of want one chart to talk about how is the consumer doing, this is it. They're doing just fine.
Awesome. No, I think that's super helpful. And then as we maybe transition into, okay, so what do we see on a go forward basis, right? And I know like I said, we talked about kind of that AI revolution that really has been in the headlines for some time now. What does that mean, Scott, from a productivity standpoint, and why do we think that's such a big deal?
It's a big deal because you don't get it very often. It's a big deal because productivity shifts are something that we get once in a generation if we're kind of lucky. And by productivity, I just mean doing more with less, or doing more, making more things, being more productive, making more income with the same resources, the same number of people. And the thing that drives productivity shifts is always something having to do with technology. And the last time we had a big productivity shift, it was the internet and PC stuff in the mid 90s, late 90s. And that drove a massive amount of good through the economy, because productivity shifts are fundamentally supply curve right types of phenomenon, which we all know from thinking back to our Econ 101 is downward pressure on interest rates and inflation, and upward pressure on growth and GDP. It's a good thing. It's just really, really hard to engineer. It's really hard to come by. Can't really do it with the government. It really needs to be kind of bottom up kind of technology getting these things done. And what we've been positing over the last 6 months, if you've been listening to us, is that these things with AI, these things with quantum computing, these things that we're starting to see populate a lot of media and a lot of attention span is real. This is not the crypto blockchain kind of garbage that was nobody really understood how to actually use. Those things were all fine, but nobody really used them to improve their business. AI is super easy to figure out how to use to improve your business. Or maybe not super easy, but it's much more accessible than those other things were, and probably as accessible as PC. Everybody trying to figure out how to use a PC and the internet in the 90s. And so, if we are on the cusp of one of these revolutions, or one of these sort of long-term trends, it is going to be a massive tailwind to everything, economy-wise and markets-wise. And again, it's just one of those things on a long-time scale. You ignore it at your peril.
Scott, I think what's really interesting, and this was something that maybe surprised me as we talk about productivity gains, is if you actually kind of take a snapshot of productivity just within the S&P 500, right? And we're looking at it back to the mid 80s when we just talked about kind of that last technology revolution really kicking off. What we've seen over the last 10 to 15 years is you really haven't seen significant productivity gains, right? They've really been pretty static within some of those companies. So then to your point, is if you get that kind of that change of direction, right, in terms of productivity growth, I think what we could be looking at is, whether it's the S&P 500 or other companies that are able to benefit, you can actually see this chart specifically as we're looking at productivity where it's being measured in revenue per worker. You can actually see that take off again for the first time in, at this point, 2 decades.
Yeah, and look, if you're worried about profit margins getting squeezed because inflation is going down, like here's your antidote. And Austin, you said it well. Like it's a little bit depressing to think about the fact we haven't had any sort of gain in this revenue per worker metric. In the S&P 500 at least for the better part of 20 years. But these things don't tend to last forever. And if we can get that mid-90s types of phenomenon, the mid-2000s is a little bit goofy. That's a lot of financial engineering with respect to like banks and things like that. So like I wouldn't pay as much attention to the mid-90s, the mid-2000s one, but the mid-90s one is the one that I think is probably more applicable. And if you can get that sort of lift from technology, from productivity enhancements, from that type of thing being implemented in companies, not just being cool to play with, but actually being implemented to improve processes and everything, then you can get this revenue per worker going up again for the first time in almost a generation. And that is going to be, again, a really powerful tailwind for stocks.
Well, and Scott, let's maybe even go a step further. And we're looking at revenue per worker in the S&P 500. I think what's really interesting, at least right now, is it appears that this could be a lot more impactful for larger cap companies than smaller cap companies. So let's maybe explain that a little bit.
Yeah, and this is one thing that I think is important to understand. These benefits are not likely to accrue equally amongst all companies, either in the cap spectrum or in the geographic sort of realm. And so, one thing we're going to have to pay a lot of attention to is how our larger companies going to become even more productive, even more sort of powerful relative to small cap counterparts, or is the U.S. going to outperform even more against Europe or some of these other places because the large data-rich companies in the U.S. are just better at instituting and kind of using the technology that's available right now, the enhancements that are available right now to further their business processes and improve productivity. That's something that we're monitoring right now. It looks likely that that's going to be more of a large cap phenomenon than a small cap phenomenon. But if we can get more sort of market wide kind of help, it'll be important. But this is one of the things that we're monitoring from more of a asset allocation standpoint.
Well, and Scott, maybe that then dovetails us into this kind of last section as we talk about fundamentals. I think what's really telling is maybe coming off of that last slide, expectations for some of those small cap companies really just aren't there today as we look out into 2024.
Yeah, look, I mean, small caps obviously have had a really tough run over the last couple of years. Notwithstanding just the amazing return in December, but which was kind of technical in nature, a lot of short covering, a lot of kind of bargain stuff like that. But on the go forward basis, like what do we think about small caps? Right now, we're not super excited about them. Now, this may end up changing, but the reason why we're not super excited about them is because they're just not growing fast enough. They're just not they're not showing the types of both either top line or bottom line gains that we would want to see in order to get really excited about a medium to longer term case for investing in small caps. Here's the caveat to that, though. The caveat to that would be, as the Fed pivots and as rates come down and as financial conditions continue to loosen, that actually will benefit small caps more. And so we got a little bit of a tug of war going on right now, where their earnings and their top line growth isn't fantastic, but they are more geared towards rate decreases. They are more geared towards cyclical upswings in the economy. They are more geared towards easing financial conditions. And so if we do get a lot of that stuff happening, that may overcome sort of this earnings backdrop that's been pretty poor for small caps for the better part of 2 years. But this is again like one of those asset allocation kind of arguments and discussions we're having internally right now. But I'm just trying to give you both sides of it. Like from a fundamental standpoint today, don't look great. Our hope is that we're going to be able to get excited about them come second quarter or so, or at least later in the year. But it's going to be because probably of that gearing towards a faster economy.
Scott, you touched on kind of specifically to the small cap segment of the market, kind of the earnings challenges that we've had. But to be fair, it's really been a challenge earnings wise for some time now, really for the broader economy, right? We technically kind of went through an earnings recession. If you actually look at EPS growth year over year, you can see that with those darker colored bars on this chart. I think the good news is you've actually started to see that change directions. And I think we're talking about tailwinds as we look out into 2024. We've obviously talked about Fed cutting rates. We've talked about the strength of the consumer, but that all goes hand in hand with the fact that then you've got projections for earnings to really start to pick back up. You can make the case that it's coming from any number of things that we've already talked about, but that outlook really, pairs nicely with a positive outlook for the markets. I think, Scott, maybe the question that we've been getting is, okay, so what does this mean from as we start to incorporate fixed income, right? If rates are going down, but you have fixed income kind of at a place where folks, maybe rates are still going to be higher than they were. Are you going to hit a maturity wall? Are you going to have problems when it comes to refinancing? Let's really dive into some of that as we get those questions around, hey, is there going to be a maturity wall that we should be worried about? Is there going to be refinancing that's going to be problematic? Like, what does that look like?
Yeah, the maturity wall and refinancing stuff. I mean, look, I stole this title from something I tell my boys when they try to wrestle me, and I tell them, like, I can't tell them this very much longer if at all, but I just say, listen, there will be a day, but that day is not the day. I'll still put you on your back. But related to this, it's like, yeah, if rates stay up here for the next couple 3 years, could be a problem. Like, definitely gonna be a problem for the high yield space, for the smaller companies, for the more levered companies, because they will start running into some maturity walls. But guys, like, look at this chart. I mean, we're just not talking about that much money. We're talking about a lot of time to plan for it. Additionally, so high yield companies are going to be more of your smaller cap, more levered types of companies. The inset chart is, what does the S&P 500 debt look like? 80, it's almost 80% is long-term fixed rate debt. Like, are we? In answer to to answer the unasked question of, like, why haven't Fed rate increases killed the economy and killed companies yet? It's because of this. Because, like, companies don't need to borrow, and because they're flush with cash, and they turned out their debt when rates were really low. Turns out CFOs are generally pretty smart guys, gals, and so it's like, this is not this isn't anything to really worry about today. I'm not saying it will never be something to worry about, but as of coming into Q1 2024, this is not something that should be on your radar in terms of a material risk to either markets or the economy.
That being said, Scott, I think what's interesting is if we start to look at some of these fund manager surveys, which we've got a couple slides here that look at that, what we're seeing is, just an economy, or I would say an investor, or in this case, fund managers, that still remain pretty bearish on kind of the outlook. And that's in spite of a lot of what we talked about. So, Scott, maybe let's give a picture of what we're looking at here, and then we can talk a little bit about kind of what that means from a positioning standpoint as we get in the next couple slides.
Yeah, I mean, look, I think all you need to see is, like, the percentage of investors, and this is from the fund manager survey, said, Austin, like, this is BAML coming out and interviewing basically a whole bunch of mutual fund and hedge fund managers, and saying, like, what do you think about these series of things? Percentage, like, expecting a stronger economy is, like, pretty darn low. It's not as low as it was coming into last year, but it's not great. We're kind of like plumbing, like, mid 2000s levels, like 08 levels. This is not an investor base which is super bulled up on the economy. Like, people don't think this is a very good economy, nor do they think it's going to be one for a while. So that actually is like a little bit counterintuitive, but it's probably a little bit helpful on the margin for people to think that things are not, that the economy cannot climb this wall of worry, and when it had, in fact, it has been doing a pretty good job over the last 12 months.
And Scott, if we talk about that, then what's also interesting is, yes, you have folks that are relatively bearish, but then you also have folks that are maybe unwilling to hop over to the other side of the fence, right? They're not planning to increase equity exposure. They don't think that the recovery in equities, maybe that we saw in the fourth quarter, we saw kind of back half of 2023, is sustainable. Like, that goes hand in hand a little bit, but it's also kind of an extension of what we're talking about from that bearish nature, right?
Yeah, look, man, I think these pictures paint I think these kind of charts paint a picture of a group of managers, a group of people that missed the rally in the fourth quarter and are kind of hoping for the pullback. So, like, I think there might be a little bit of hope sort of embedded in some of these answers, but it is, like, people don't think that was a real rally. It was, but people don't think that it was, and so that is, again, probably on the margin a little bit helpful, at least for the short term.
So the last piece here, as we talk about positioning, I think is pretty interesting, because it maybe paints a slightly different picture in terms of a little bit farther out, right? If you get to the end of the year, what are expectations for the S&P 500? And Scott, you actually have a maybe a fairly optimistic in the grand scheme of things outlook that you're getting from folks. So maybe how should we read this? What does that mean? How does that pair with the fact that folks are still pretty bearish right now?
Yeah, I mean, this is an interesting sort of setup right now, right? I mean, like you like on the one hand, if people not expecting a stronger economy and think that the sort of the Santa Claus rally was fake, and then they're like, the next question is like, so what do you think about the S&P at the end of the year? And everybody's like, up 5 to 10%, easy call. And so like those things again are a little bit of loggerheads, but it does point to the idea that folks are at least coming around the idea that they may have been wrong about the recession, like they may have been wrong about at least the obviousness and sort of the inevitability of the recession and the inevitability of another bear market, and inevitability of the return to the October 22 lows. Like those things were just like, they were sort of fait accompli. Like everybody just thought it was obvious. It had to happen. And so at least sort of the investor psychology may be turning a little bit, and maybe that'll end up being able to turn sort of retail psychology a little bit as we kind of move through the year. I think this is, this will end up being helpful as we walk through time. But it is definitely indicative of an investor base that doesn't really know what to think about the world right now.
So Scott, we'll end on this slide, and I think what's interesting is this chart on the left actually kind of goes hand in hand with the expectations that we just outlined. If you actually look at the chart on the left, we've had a lot of folks ask us, well, hey, 2023 was so strong. Doesn't that mean that there'll be some sort of mean reversion in 2024? And actually, history would tell you maybe the opposite to some extent. This is looking at S&P 500 returns for any time that the S&P 500 returned more than 20% in a given calendar year. It looks at the following year. And what it tells you is history would suggest that 80% of the time markets go higher in the next year. And on average, you're looking at another double digit, granted a lower double digit return, but you're looking at 10 to 12% on the upside. And I think, again, that goes hand in hand with that previous slide. But I think the chart on the right, and Scott, I'll let you unpack this, really kind of speaks to the fact that in a period where Fed's cutting rates and you're not in a recession, history would suggest that we're much closer to the black line in terms of expectations for total return, as opposed to the blue line where you're getting rate cuts, but you're in a recession.
Yeah, I mean, and I think that's really kind of the key point. If we get rate cuts, and we get rate cuts that are neutral in nature, rate cuts just to get from restrictive territory back to quote what the Fed considers normal, again, this 2.5 to 3% Fed funds range. If we get rate cuts like that, then we're more likely to be following this black line. And that black line would again suggest like this, kind of low to mid double digit return in the S&P for this calendar year. If, however, like something happens and we roll over and we're wrong about the economy, and we tip over into recession, we're still going to get Fed rate cuts. They're just going to be faster. There'll be more of them, and they'll go down to 1% or 0%, depending on kind of how severe things are. And then we're probably more likely kind of following this blue line. But in either case, we're not we're not looking for, and history would not suggest at least that 2024 should be a terrible year. Like it should either be a reasonably good year or just kind of like okay, the time passed and we sort of marked it and we're okay. Let's try again next year. But we're certainly not calling for any kind of catastrophic market. Again, barring something outside happening, barring another pandemic or some war or something like that. But the facts on the ground that we know right now, the internals of the economy and the internals of the global economy point, and what's going on with central banks, all point to a pretty reasonable year this year. And so that is our expectation. Hopefully, we've done a reasonable job of outlining kind of why we think what we think. But we do think that is like we're more likely to be approaching this more like the black line than the blue line on this chart over there.
And Scott, I think you kind of highlighted a pretty important piece of information there. Is everything we're talking about today, right, is based on the data that we're seeing right now. That's not to say that things can't change dramatically, a month from now, for that matter, tomorrow. But for that matter, what we're looking at today, data-wise, kind of supports what we've been talking about in terms of the fact that maybe we're not in a traditional business cycle, that you're seeing a Fed that's expected to pivot and to some extent pivot pretty quickly, which could be kind of dovish for markets broadly. I think you're talking about a consumer that's maybe not nearly as bad off, if you will. And then the productivity piece that we talked about, I think, is extremely important. We touched on kind of the fundamentals piece, but Scott, we have had a couple questions come through as we've been going through this. And the first one, and we didn't talk a lot about specifically this asset class, but bonds. As we're looking at bonds in 2024, is 2024 the year that bonds come back? What should we be expecting from the bond portion of the portfolio? Like, what's the view on bonds as we head into 24?
Yeah, look, I mean, we certainly more constructive on bonds than we have been in the last couple 3 years. Thankfully, I mean, like, can't go down every year, right? Bonds this year, I think it'll be fine. Think 5% total return on like not inflation adjusted, just like a kind of regular return. That's probably what we're looking for right now in terms of the investment grade U.S. bond portfolio, which would be fine. It's certainly better than -15, -5, or -10. That said, I think equity is going to do a lot better than that. I think if you had a druthers, you'd probably lean more into the equity side of things. We don't think the bonds are going to be sort of the massive drag on portfolio performance, a massive drag on risk-adjusted performance that they've been for the last 2 or 3 years.
Well, and maybe going hand in hand with that, Scott, you've seen a lot of people kind of go to the sideline, right, over the last 12, 18, 24 months. Given the fact that the sideline, we'll call it CDs, you'll call it money markets, you can call it, short-dated treasuries, has been paying 5.5%, 6%. So you've got a lot of people on the sidelines. Is there anything that we should be looking at in terms of getting people off the sidelines and getting them back invested?
Yeah, look, I mean, five sounds great until you take away inflation, and now, at least last year, and on average it was 3. So now you're looking at 2 real, and stocks are up 20. Like, all right, so you got 2 or so. I mean, like that, that math doesn't work very well. And so, I do think that clients and advisors alike are probably going to be, searching for ways and reasons to get back invested again, like cash. It'll be okay. You can mark some time, but just think there's going to be like a lot better places to be, both from a risk standpoint and from a return standpoint. If you're a goal-based investor, like if you have goals and like you need your money to work for you, and gains can not only help fuel financial plans, but they can be a really, really great, like a great risk management tool as well. And so the exposure to gains, exposure to markets is going to be, I think, one of the key things that we can get clients to do this year is like get out of that cash that sounded so appealing, 5%, because by the end of the year it's going to be 3%.
So Scott, last question, and I apologize in advance for having to ask it, but it is 2024, which means that we're getting to an election as we head into November. I guess kind of what's the view on 2024 being an election year? Is that added volatility? What does that mean? And then maybe another question that came in is, with 2024 being an election year, does that impact the Fed's decision to cut rates, the speed with which they cut rates? Like, is there any impact there from a Fed perspective? So what's your thought?
I wish I could do something about 2024 being an election year, but alas, they don't ask me when they set the calendars. And so it is, look, it's an election year. And by the way, it's election year around a lot of the world as well. So we have Taiwan elections coming up this weekend. Those are going to be important. Like, there's elections all over. Like, India is going to be important this year. There's elections all over the world. So it's not just the U.S., but the U.S. obviously is going to take a lot of the air in the room. And so in terms of markets, can it matter? Yeah, it can matter. Is it likely to matter? Not really. Unless something really squirrely goes on, or you have some massive, like, real civil unrest, then you can see confidence getting hurt, and that coming through like consumer spending channels. Like, that's sort of the channel through which you might expect something to happen. But that's certainly, it should not be anybody's base case. It's not our base case. Elections are really, I'm not sure if fun is the right. I was going to say fun to talk about. They're probably not fun to talk about. They can be interesting to talk about. But just the fact of the matter is, like, they don't really impact markets that much. The economy and markets are just much bigger than one guy or one gal, depending on who ends up coming in for the presidential for the election. And so it's not something we spend a whole lot of time worrying about until we get pretty close, or until we see something that may look like it could be squirrely, again, from a consumer confidence standpoint. So we'll obviously be talking about this more as the year goes on, but it's not of chief concern right now. We're talking about the Fed and will politics affect rate policy? Look, we don't think so, but it could impact Treasury policy. So Treasury is an arm of government, and the way Treasury issues bonds, they can make a choice about whether to issue long-dated bonds or T-bills or anything like that. That may have something to do with it. It shouldn't be a surprise to anybody listening to this call that people that work in the government want the government to continue in its current state in terms of party affiliation. And so Democrats are going to want to try to juice the economy. They're going to try to get the economy going really good by November. Yellen is a Democrat. She's working in a Democratic administration. And so, like we should expect things like Treasury to try to act in probably more of a partisan manner. But the Fed hopefully will stay more down the middle. Don't think it's going to change what they want to do, because what they want to do is get the economy on a soft landing, and they've kind of already said how that's going to work, and the market has basically priced it in. So whether we think that the Fed wants to juice things or not, we think they're going to kind of listen to what the market's telling them. And if they do that, we think they'll be all right.
Awesome. Good stuff. No, Scott, really appreciate your time. And thanks everybody for sticking with us and going through kind of our outlook as we head in. Don't hesitate to reach out if you have any questions. Like I said earlier, we will absolutely be sending out the slides and the recording of this webinar. We would love for that opportunity to talk to even more people about kind of what we're seeing here at Horizon and how that affects your business and working with your clients. So with that being said, we will wrap for today, and we look forward to conversations and being with you in the coming weeks and months. Thanks so much. We'll see you soon.